Ladies and gentlemen, you have just clicked on one of the best, if not the best videos on how to successfully lose money over time in the stock market with consistency. It doesn't say guaranteed on the board for nothing. I'm not kidding. I have all the facts, all the data on how to successfully lose money in the stock market. Now, there's all sorts of videos and content and articles out there on the internet that teach people how to be successful making money in the stock market, getting rich in the stock market. I'll admit, I'm even guilty of uploading some of those videos. But what about the people that want to lose all their money in the stock market, that never want to make money? Well, this video is for you, so don't click away. More on that coming up. In this video, we're going to cover 4 main ways to lose money as early as today when you get started investing in the stock market. This will essentially guarantee you losses with consistency over time. We're going to cover market timing, we're going to cover investment selection, we're going to cover on how to lose money in the stock market with current events. We're also going to talk about some really nice money-losing investor traits. Now again, this will essentially guarantee you to lose. And if you stick around to the end of the video, I have a really nice bonus of why you might be angry with me by the end of this video. So without further ado, let's hop onto my computer and we'll get to business. And here we are in my computer. Now, I don't want to be negative right off the bat, but I feel like I have to disclose this. I don't want to discourage you, but it is hard to lose money in the stock market, right? It takes consistent effort. It takes diligence, right? It does take a lot of time and effort to lose money in the stock market, but it's not impossible. I want to let you know that. In fact, a lot of people lose money in the stock market, okay? And that's where all this data has come from. So it is possible, right? A lot of people do it. I'm just saying it takes a lot more time and effort to lose money in the stock market rather than make money in the stock market. So now that you know that, I don't want you to feel like it's easy to lose money in the stock market, okay? So I just want to be honest with you up front. So let's talk about market timing. Timing the market just right to where you lose money. So what this shows here, and again, this is hard data, direct from Morningstar, okay? And it says, no one has a crystal ball, yet often people act as though they do, okay? So missing even the 10 best days in the market reduced returns by almost 50% in the last 20 years. So let's take a look at this. The red days on these calendars are negative days, right? And the blue days are really positive days. So despite 2008 being the center of the Great Recession, it had 8 of the 20 best price return days for the S&P 500 since 1998. So investors that stayed fully invested through 2008 in the S&P 500, they made the most money, right? Now, the more we try to time the market, the more we try to get in and out, right? Timing the market, we're going to lose money. So if you want to lose money in the stock market, rule number 1 is try to continually predict which direction the market is going to go, right? Because then you're essentially guaranteed to lose money, right? Even missing the 10 best days in the market will essentially cut your returns in half. So there you are, you're halfway there. Now, if you get in and get out a lot, you have to spend some time at it. If you get in and out of the market a lot, it's likely that you're going to have really good negative returns down here. So again, rule number 1 is be sure not to just buy something solid and leave it there, because you will make money, right? It's just a matter of time and leaving it there. So always try to time the market, right? Act like you have a crystal ball, even though we all know none of us do, and time the market. Now, to expand on this, I want to show you this chart. It shows that over the past over 100 years, the market has had positive returns about 3/4 of the time. So like I said, we only have about a quarter of time to lose money in the stock market. So we have to be very diligent in this. The average annual returns of long-term investments over the past 100 years has been over 10%. This is double digits. This is not good if we want to lose money. And this shows you the drawdowns right here. So the S&P 500 drawdowns and market cycles since 1945, and then the time it takes to recover. So you see these dips, -5 to 10%, -10 to 20%. And here's the time span that we have in order to lock in our losses, right? So as long as we sell within this 3 months at a loss, we're going to lock in those losses. And again, that's what we want to be consistently trying to do, is sell when the market goes down. Because when prices go down, we want to lock that in, right? We don't want to wait 3 months for it to go back up. That wouldn't make any sense. We'd be making money. So again, we only really have about a fourth of the time in the markets to lose money, because a majority of the time that people stay invested, they tend to make money. And again, that's not the goal here. This is another interesting chart. It says that the market is much better than gambling, right? Blackjack, roulette. Here are the chances of winning at these various games. And then unfortunately, here's the chancing, the rolling monthly returns of the S&P 500 and all the years that they posted positive returns. So just investing 1 year in the market, if you just buy the S&P 500 and wait 1 year without touching it, right, without trying to time the market, you have a 75.7 chance of being positive. Again, we don't want that. We want to lose. So as you can see, the longer you leave your money invested, the higher the chances of being positive. So really, any 15-year period in the S&P 500, 99.8% chance you're going to make money. Here's one of the best ways to lose money, right? Be wary of herd mentality. From the tech boom to the so-called fear trade, investors often position themselves poorly at the most inopportune times. They're talking about making money. So let's just say we position ourselves best at the most opportune times. Here's an analogy that illustrates the single greatest challenge people face when dealing with the stock market. How do people respond when there's a significant markdown in prices at their favorite department store? They run into the store searching for bargains, right? Because everything is 20, 30% off. But then how do they respond when there's a significant markdown in prices in the stock market? 5, 10% off, like we've just recently had, or that we'll have again in the future. They often run out of the store and they don't return until prices get back to full retail. So that's what I want to show you here. When we see a sale on our department store right here, we run in because we want our favorite shirt or our favorite shoes or our favorite watch or bag at 50% off. When we see a sale in the stock market, we want to excel. We want to cut our losses to lock them in and run out of there. And then we better not buy back in until the market goes back up, right? Because we want to buy things at a high price and again, let them drop and then we sell. That's how we successfully lose money. So keep this in mind. We always want to run out of the stock market when it's going down because you want to sell things at a lower price than what you bought them for. That's how you lose money in the stock market. Now, if we can successfully watch all the different news channels and use our feelings and emotion and short-term thinking, it's highly likely that our behavior will cause losses for us. So again, we have to put some effort into it, but if we watch enough news and we read enough headlines about the sky falling, I think we can make it happen if we truly believe it will and sell all of our stuff. So really, like I said, the average investor is pretty good at underperforming and losing, right? Only 2.6% out of all the different asset classes. That if an investor just bought US stocks and held them, you can see over the last 30 years essentially that he or she would have made double digits returns. So again, if we can act off of unbridled emotion, right, we can lose money due to our short-term fear and greed and emotional feelings by making decisions in our portfolios. And since we mentioned current events, I'd like to show you guys, this is the past 100 years of the stock market. Now I know it's tough to read. I'm going to try to zoom in here, and here we have all these different major world events in these black dots, right? Like the Chrysler bailout, Black Monday, savings and loans bailout, Berlin Wall torn down, deregulation, Asian currency crisis, Bear Stearns collapse, U.S. debt downgraded, subprime, you name it, right? So there's always a crisis, there's always a major global event in the world that we can get emotional about to take action in our portfolio and create losses. Again, it shows us that we have many chances over the course of time to lose money in the stock market, right? Because people will say, this is the last one, this is the last opportunity, the sky is falling, so we sell, and lo and behold, those tricky bastards, another event comes up and they say the sky is definitely going to fall this time, and it just doesn't seem to ever fall. But we sell anyways and we lose money, so it works out. So this just shows us that there's always global events out there that's going to create all this fear in the market. And again, it's important that we sell during those times to lock in our losses. Now, let me show you what happens when you don't lock in your losses. Let's go to that page. So what we're looking at right here is the S&P 500 from 1983 all the way to the end of 2017. Now this is what I mean by it does take more time to lose money in the stock market than it does to make money. So watch closely here. Here's what this chart shows. The black, and we'll call it lime green, shows you the highest point that the S&P 500 got to in that specific year. So 1987, the highest point the market was at was 5% in the positive, and on and on and on. Now, in the negative, let me show you the negative at any given point. Like I said, 1987 was also negative 33%. That's a good time to sell during that point to lock in your losses, right? Because as you can see, since 1983, there's only been 5 years, right, out of the past several decades where if you just left your money alone, you would have lost money by yourself, right? But all the rest of the time, you're going to be positive, right? So again, it's very important that we actively get into our portfolio and treat it like a bar of soap, right? The more we handle it, the less we're going to have. And that's the whole goal here. So as you can see, at any given year, our portfolios can be up about 15%. They can also be down about 9%. And again, that's really when we want to sell, and we don't want to buy back in until we see it going up. Let me show you why, and let's look at this even further. So if we were just to buy the S&P 500, right, which we'll get to in a moment on what that is and how easy it is to make money there, so you have to be careful. If we were just to buy the S&P 500 in 1983 and hold it until 2018, 2019, what would our returns be? Well, if we were to buy it in July of 83 and hold it until July of 2019 and not sell, not do anything, just simply automatically reinvest the dividends, we would have an annual average rate of return of 10.9%. Now, if we want to lose money, this is a terrible idea. This is a terrible idea. So this brings me to my next lesson. When you want to lose money in the stock market, when that's your goal, you really want to make investing as complicated as possible. So when people talk about boring mutual funds that just seem to make returns over time, or just buying the simple S&P 500 and just leaving our grubby little mitts off of it, that will make money. So if you're not careful, if you just buy that and let it go, you're going to make money, right? So what you want to do is you want to get into very complicated, inverse exchange traded funds, or you want to get into futures, you want to get into really complex options tradings, and you don't want to do any research on it. You just want to jump into it. So again, be careful. If you buy a basic investment like the S&P 500 and just leave it alone, you're going to make really, really, really good returns if you just leave it alone. Now, if we interfere with that, it's likely that our returns will be much less. Now, keep in mind that every generation faces its fair share of challenges, right? And so we want to believe the news when they say the sky is falling, and we want to sell again to lock in our losses, because as you can see, if we just let our investments operate how they should, they're going to make us money, unfortunately. Now, it's sad to say that another unfortunate thing is it really doesn't matter which party is in control of the government. The markets seem to, over the long term, kick along just fine. So unfortunately, hating a certain political party, unfortunately, is not going to help us lose any more money. So, while waiting for someone's team to win or lose, even a divided government gives us, on average, 7% annualized rate of return. And here's how we successfully lose money when we base it off of politics. Now, if we stay fully invested during both parties, right, during Bush years, during Obama years, during Trump years, and whoever's next, if we stay fully invested, we're going to make a lot of money. Now, if we only invest when certain parties are in office, here's our returns way down here, right? So we lose a lot of the time. So here's what we have to do. Again, we have to make decisions based off of outside factors like politics and certain things like that. And that's how we can substantially lower our returns in the long run. All right, so here we are at the end of the video, and I'd like to address why there might be a small percentage of viewers that are angry with me because of this video. You might feel cheated, you might feel lied to, and I can understand that, because right now you're thinking about commenting down below and saying, you know what, Kenny, this is all BS. I know 4, maybe even 5 famous, successful investors that have made a fortune. They haven't lost money. They've made a fortune timing the market. They've made a fortune with high risk and convoluted investment selections, right? No diversification. They've made a fortune trading off of current events, and they've made ridiculous money with short-term and aggressive thinking. So you lied to us, Kenny. Well, okay, fine. Let's make it fair. Let's make it fair. I don't even want to say guaranteed. You're right. There are 4 or 5 investors that have gotten rich off doing this. I have one question though. Out of those 4 or 5 investors, how many others have lost, right? There's millions and millions of investors in the stock market, but we can only name 4 or 5 that have gotten rich doing this. Why are they famous? oh, wait, because they got rich doing these things. You're right, though. I'll respect that. So nothing's guaranteed. So let's rename this, okay? How to 99.9% of the time fail and lose money in the stock market. I'm sorry, guys, you're right. I shouldn't have said guaranteed. So now that I've modified this to make it truthful, I'd like to invite you to watch the other videos on my channel that give investors a much better chance of success long term. As always, I'd love to hear from all of you in the comments section with questions, comments, and even future video ideas. Thank you so much for watching, and we'll see you guys next video.